Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic with us is accounting for fair value hedges, and it is accounting basic thing that we are trying to understand. So let's try and understand in detail format. Now the accounting for the fair value hedges, a fair value hedge of the exposure to changes in the fair value of any asset or liability or any such items that is attributable to the particular risk, and it can result in either profit or loss. So a fair value hedge results in the fixed value item. Okay, now the fair value hedge pertains to a fixed rate returns or the fixed value items, and the basic step involved is you need to first determine the fair value of both the hedged item and the hedging instrument, okay, used on the date of the reporting of financial statements. So if there is a change in the fair value of the hedge instruments, recognize the profit and loss in the books of accounts. Second, if there is a change in the fair value of hedge instrument, you need to record any changes. Lastly, recognize the hedging gain or loss on the hedged items as in the carrying amount. So how does the accounting part goes? Let's say company Fair has an asset with its current fair value. Let's say it's standing at $2,000, and the management is concerned that the fair value of the hedge will go down to, let's say, 1900. So this will result a loss to the company. So to offset the loss, the company enters into the offsetting position through, let's say, a derivative contract which also has a fair value of, let's say, 2000. Now, since this is an offsetting position, its fair value will move in the opposite direction as that of the hedged item. So at the time of the closure of the books, the following scenario are possibles. Now there is a case one where there is a decrease in the fair value of the hedged item and simultaneous increase in the fair value of the offsetting hedged instruments. Over here, there is a net loss in the first case when the value of the hedged item is 1,92,000. The gain or loss is 80. So the value of the hedged item is 2060, and the gain and loss is 60. Net gain is 80 and 60, that is negative 20. So in this fashion, all other calculations are done. So in the second case, there is an increase in the fair value of the hedged item and simultaneous decrease in the fair value of the hedged item of the offsetting hedged instrument. So same calculation goes around, just a little change. Now, I want to take you to the journal entry part. Well, what will go in? So first, a loss. Let's say there is a loss on the hedging the item of the reporting date. Over here, there'll be debit the loss to loss on the hedged item account. Okay, so this will have an effect on the what we call as the profit and loss account, and it will reduce the profit of the company. Now over here, there'll be a credit the hedged account or the hedged item, since this is an asset and the value of the asset will go down, and this will affect the financial position, that is the balance sheet of the company. Now second, if there is a gain, what if there is a gain in the hedging item of the reporting period? So in gain, we'll debit the hedged item since this is an asset and the value of the asset will go up, and this will affect the financial position, that's the balance sheet of the company. Now this will have an effect on the profit and loss account, and there will be an increase in the profit of the company. Okay, right. This was in case of the gain part. Now, how about in case of the hedging instrument where there is a loss on the hedged instrument account? What if this case? Okay, and if in this scenario, if there is a loss in the hedging instrument of the reporting period, how things will go? Well, in this particular scenario, this will have an effect on the profit and loss account, and it will reduce the profit of the company. So if you go over here, you see that they'll on the credit hedged instrument, since will be crediting the hedge instrument because there is an asset and the value of the asset will go down, and this will affect the financial position of the company, that is the balance sheet of the company. Now if in this scenario, if gain occurs, gain in the hedging instrument of the reporting period, then we will credit the hedged item since this is an asset and the value of the asset will go up, and this will affect the financial position, that is the balance sheet of the company, and this will have an effect on the profit and loss account, and there'll be increase in the profit of the company. So the net effect, if you see, net effect of both hedging items and the hedging instruments, the net loss on account on the date of the reporting period will decrease. The net loss will reduce or will decrease the overall profit of the company. And the net reduction in the net asset of the company. Second, in case of the net gain of the reporting, there'll be a net increase in the net assets of the company, and the net gain will increase the overall profit of the company. So that's it for this particular topic of accounting for hedges. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.